Would you believe one of America's quietest millionaire businesses looks like this? Just rows of metal boxes behind a chain link fence. No neon signs, no crowds, no excitement. And yet, this boring-looking business generates over $50 billion a year in the U.S. alone. Welcome to the self-storage industry. It's one of the highest margin businesses in real estate, and almost nobody talks about it. So how much does it actually cost to own a self-storage facility? And how does a building full of empty boxes make anyone rich? Let's open the door on this quiet money machine. Self-storage is exactly what it sounds like. You rent a box, you keep your stuff in it. No lease, no long-term commitment, just a monthly fee for space. The idea is surprisingly recent. It only took off in the 1960s. Texas is often credited as the birthplace of the modern self-storage industry. Since then, it has quietly grown into a nationwide industry of tens of thousands of facilities. Today, roughly 1 in 10 American households rents a storage unit. That's more storage space per person than almost anywhere else in the world. Why? Because Americans move often, downsize often, and simply own a lot of stuff. Divorce, downsizing, small apartments, business inventory. The reasons never run out. And that's exactly what makes this business so quietly reliable. Now let's talk about what it actually costs to build one of these facilities. Building a self-storage facility from scratch isn't cheap, but it's far cheaper than most real estate. A mid-size facility typically costs $3 to $6 million to develop. Land is usually the biggest expense, especially near cities. The buildings themselves are simple. Metal frames, concrete floors, roll-up doors. No plumbing in most units, no complex electrical work, no fancy interiors. That simplicity is exactly why construction costs stay so low compared to housing or offices. Buying an existing facility is often even more common than building one. Existing facilities can sell anywhere from $1 million to well over $20 million. The price depends on location, unit count, and how full it already is. A fuller facility in a busy area sells for a much higher price per unit. Unlike apartments, you don't need dozens of maintenance staff or property managers. Often, a single manager or even a remote system runs the entire property. So the entry cost is high, but nowhere near what other commercial real estate demands. Now, where does the actual money come from once the building is up? Let's break down the revenue model. Most buyers don't pay cash. They finance it, just like a house. Commercial banks and SBA loans are the most common ways to finance a facility. Lenders usually want a 20 to 30% down payment. Before buying, serious investors calculate something called the cap rate. It's a simple formula: annual profit divided by the purchase price. A higher cap rate usually means a better deal, but often a riskier one too. Self-storage cap rates typically range from 5 to 8%, depending on the market. Serious buyers also check the facility's occupancy history for the past several years. They inspect the physical condition: roofs, doors, drainage, security systems, and they study the local competition. How many other facilities are nearby and how full are they? Skip this due diligence, and you might overpay for a facility that's quietly struggling. Do it right, and you can spot a hidden gem before anyone else does. The core revenue is simple. Rent, paid monthly per unit. Units range from small closets to garage-sized spaces. A small unit might rent for $50 to $100 a month. A large climate-controlled unit can rent for $300 or more. Multiply that by hundreds of units in one facility, and the math adds up fast. A facility with 500 units, mostly full, can generate well over $1 million a year. But the real secret weapon isn't the rent. It's occupancy. Self-storage operators obsess over one number. How full is the building? A facility running at 90% occupancy is dramatically more profitable than one at 60%. because the costs to run the building barely change, whether it's half full or completely full. That's the magic of this business. Costs stay flat, revenue keeps climbing. And here's something most renters don't realize. Rent increases happen constantly. Operators quietly raise rates every few months, especially for existing tenants. Most people don't bother moving their stuff over a small price bump. That quiet inertia is one of the industry's best kept secrets. So, renters stay, prices creep up, and margins keep expanding. But rent isn't even the only way this business makes money. So how does a plain metal building actually attract customers in the first place? Location matters more than almost anything else. Visibility from a busy road is gold. Search engines are the modern front door. Most renters just Google storage near me. Online reviews can make or break a facility's reputation overnight. Many operators offer a steep discount on the first month to get renters in the door. Once someone moves their boxes in, they rarely rush to move them right back out. That's the real marketing trick. Get the door open once, and inertia does the rest. There's an entire layer of extra income most people never think about. First, mandatory tenant insurance. Almost every facility requires renters to buy insurance for their stored items. That insurance is usually sold directly by the facility at a solid markup. Second, late fees. Miss a payment, and the penalty kicks in fast. Third, administrative and moving truck rental fees. Many facilities rent out trucks or vans to help people move their belongings in. It's a small convenience fee, but multiplied across thousands of customers, it adds up. Fourth, retail sales. Boxes, tape, locks, bubble wrap, all sold right at the front desk. These items cost pennies to buy wholesale and sell for a serious markup. And then there's the most controversial revenue stream of all, auctions. If a renter stops paying and disappears, the facility can legally auction off their belongings. This is the entire premise behind reality shows about storage unit treasure hunts. For the facility, it's simply a way to recover unpaid rent and clear out the space. For bidders, it's a gamble. Sometimes junk, sometimes a hidden treasure. Add it all up. Rent, insurance, fees, retail, auctions. This is a business with layers. So what does it cost to actually run all of this? Here's an uncomfortable truth. A lot of what's stored is never actually used again. Studies suggest a large share of renters haven't opened their unit in over a year. But people keep paying anyway, because letting go feels harder than paying the bill. Psychologists call this the endowment effect. We overvalue things simply because we own them. For the storage industry, that quiet emotional attachment is basically a business model. Here's where self-storage gets really interesting. Running costs are shockingly low. There's no kitchen to maintain, no elevators, no complicated plumbing systems. Most maintenance is just mow the grass, fix a door, repaint occasionally. Staffing costs are minimal. Many facilities run with 1 or 2 employees total. Some facilities are almost entirely automated, with keypad gates and remote check-in. Security is usually just cameras, fencing, and a keypad gate. No 24/7 front desk required, unlike hotels or apartment complexes. Utilities are also minimal, mostly just lighting, and for some units, climate control. All of this adds up to some of the lowest operating costs in real estate. Industry data often shows operating margins of 60 to 70% for well-run facilities. Compare that to a restaurant, where margins often sit in the single digits. This is exactly why so many real estate investors quietly love this asset class. Low costs, steady demand, minimal drama. It's the definition of a boring, beautiful business. Now, let's see just how far this quiet business has actually grown. There's another reason wealthy investors love this business. The tax benefits are huge. Real estate lets owners depreciate a building's value over time, even while it earns rent. On paper, the building loses value each year, which lowers taxable income. A strategy called cost segregation can accelerate these deductions even faster. In some years, these deductions can offset a huge portion of an owner's taxable profit. This is one of the quiet reasons real estate, including storage, stays so popular with the wealthy. Self-storage is often called recession-resistant. Here's why. When the economy booms, people buy more stuff and need more space. When the economy shrinks, people downsize, move, or sell homes, and still need storage. Either way, the boxes keep coming. That's a rare kind of demand stability most businesses would kill for. It also means self-storage doesn't need constant reinvestment like a restaurant or a retail store. Once it's built, it mostly just sits there, quietly collecting rent. This is why so many quiet millionaires built their wealth in this exact industry. Not flashy tech founders, not celebrities, just patient real estate investors. Many started with one small facility and slowly bought more over decades. It's not a get-rich-quick story. It's a get-rich-slowly one. And slow, steady, boring wealth is exactly what this industry has quietly delivered for decades. So who are the biggest players actually running this industry today? Self-storage isn't just mom-and-pop operators anymore. Wall Street noticed years ago. Several massive public companies now dominate the industry. These companies are structured as REITs, Real Estate Investment Trusts. A REIT allows ordinary investors to buy shares and earn a slice of rental income. You don't need millions to invest in self-storage. You can buy a share for the price of a coffee. The largest self-storage REITs are collectively worth tens of billions of dollars. They own thousands of facilities across the country, often buying out small, independent operators. This consolidation trend has been quietly reshaping the industry for 2 decades. For investors, these REITs have historically delivered strong, steady returns. Some have outperformed even the broader stock market over the long run. Not bad for an industry that's basically renting out empty metal boxes. But even giants in this industry aren't immune to risk. Let's talk about what can actually go wrong in this business. And this isn't just an American story anymore. The industry is going global. The UK now has one of the fastest growing self-storage markets outside the US. Countries like Japan, Australia, and parts of Europe are catching on fast too. Smaller homes, denser cities, and more frequent moving all drive the same demand worldwide. As global real estate gets tighter, storage space becomes valuable almost everywhere. Some of the biggest deals in real estate history have happened quietly in this industry. Major REITs have spent billions acquiring rival storage companies outright. One well-known merger in the industry was valued at well over $10 billion. These mega deals combine thousands of facilities under a single national brand. For small independent owners, a buyout offer from a REIT can be a life-changing payday. It's the classic exit strategy: build small, prove it works, sell big. Risk number 1. Oversupply. Self-storage looks easy to build, so everyone tries. In popular markets, developers sometimes build too many facilities too close together. That competition can crush rental rates and occupancy for everyone in the area. Risk number 2. Zoning and permitting. Not every city welcomes a storage facility. Some municipalities restrict or ban new self-storage developments entirely. Risk number 3. Natural disasters. Floods, fires, and storms can destroy stored goods fast. Facilities in flood zones or hurricane paths carry real insurance and liability exposure. Risk number 4. The auction process itself can create bad publicity. Evicting tenants and auctioning their belongings isn't exactly a heartwarming business story. Operators have to balance profit with real human circumstances behind every locked door. Risk number 5. Technology disruption. On-demand and mobile storage startups are entering the space. These companies pick up your stuff and store it off-site, no driving required. It's convenient, but it's also unproven at the scale traditional facilities operate at. So this quiet business isn't completely risk-free, but its risks are manageable, not existential. Now let's meet a few people who quietly built fortunes in this exact industry. Demand for storage isn't perfectly flat all year. It actually follows a rhythm. Summer is peak season. More people move homes. More college students need space. Winter tends to be quieter, with fewer people relocating in the cold. Smart operators adjust pricing slightly with these seasonal swings, just like hotels do. It's a small lever, but over hundreds of units, it adds meaningful revenue each year. Most self-storage millionaires didn't start with millions. They started with one small lot. A common story: a local landowner converts an empty field into a small facility. Within a few years, steady rent income pays off the construction loan. From there, many owners reinvest the profits into a second, then a third facility. Some quietly grow into owning a dozen facilities across a region, never making headlines. Others sell their portfolio to a big REIT for a massive payout after decades of patience. These aren't viral success stories. They're spreadsheets, patience, and decades of small wins. And that's exactly the appeal. No flashy pitch decks, just steady compounding. Compare that to owning a football stadium or an airline, and the contrast is stark. No paparazzi, no crashes, no million-dollar sponsorship wars. Just quiet, boring, dependable rent, month after month, year after year. Now let's put this business side by side with other real estate investments. So what does an actual day look like for someone who owns one of these facilities? Morning. Check the occupancy dashboard and see who paid and who didn't. A few reminder emails go out automatically to late payers. Midday. Maybe a walkthrough, checking locks, checking for any maintenance issues. Afternoon. A call with a potential new tenant or approving a new online booking. Evening. Review the numbers, maybe schedule next month's small rent increase. For a well-run, mostly automated facility, that's often the entire day. Compare that to running a restaurant, a hotel, or a retail store. This is exactly why so many storage owners run multiple facilities at once without burning out. How does self-storage actually stack up against apartments or office buildings? Apartments need tenants who pay rent, fix problems, and sometimes cause damage. Managing apartment tenants can be a full-time, stressful job. Office buildings depend heavily on the broader economy and corporate demand. A recession can leave office towers half empty for years. Storage units, by contrast, rarely sit empty for long, and tenants barely interact with staff. There's no upgrading kitchens, no repainting hallways, no tenant complaints about noise. This is why many real estate investors consider self-storage the lowest maintenance property type that still performs. It's not the most exciting investment, but it might be one of the most efficient. That efficiency is exactly why big institutional money keeps flowing into this space. So, where is this quiet giant headed next? Climate-controlled units are becoming the new standard, especially in hot or humid regions. They protect furniture, electronics, and documents from heat and moisture damage. They also rent for a noticeably higher price than standard units. Mobile and on-demand storage startups are also reshaping how people think about storing stuff. Instead of driving to a facility, some companies now pick up and store your items for you. Traditional operators are responding by adding apps, smart locks, and remote monitoring. The industry that once ran on paper contracts and metal keys is slowly going digital. Even so, the core business model hasn't really changed in 60 years. Rent a box, keep your stuff, pay every month. Simple and still wildly profitable. So let's bring everything together and answer the big question. Some independent owners now join branded networks instead of staying fully solo. These networks offer shared booking platforms, marketing support, and bulk insurance deals. In exchange, the independent owner pays a small management or franchise-style fee. It's a middle path between staying fully independent and selling out to a big REIT. Before we wrap up, let's clear up a few common myths about this industry. Myth 1. Storage units are mostly full of hidden treasure, just waiting to be found. Reality. Most auctioned units are furniture, old clothes, and boxes of paperwork. Myth 2. This business is a guaranteed risk-free way to get rich. Reality. Oversupply, bad locations, and poor management can sink a facility just like any business. Myth 3. You need to be a real estate expert to get started. Reality. Many owners started as regular landowners who simply saw an opportunity nearby. Myth 4. Self-storage units are only used by hoarders with too much stuff. Reality. Most renters are simply between homes, running a small business, or storing seasonal items. Myth 5. Once you buy a facility, the income is completely passive forever. Reality. It's far more passive than most businesses, but it still needs attention, upkeep, and decisions. So it's not magic. It's just a genuinely well-designed business model. Is owning a self-storage facility actually worth it? For a patient, hands-off investor, this might be one of the best-kept secrets in real estate. High margins, low maintenance, steady demand, and multiple layers of extra revenue. For someone chasing fast excitement or overnight riches, it's probably the wrong industry entirely. This is a business built for decades, not headlines. And maybe that's the real lesson hidden behind all those quiet metal doors. Sometimes, the most boring businesses quietly build the biggest fortunes. So, would you invest in a business this boring if it meant this kind of steady return? Let's quickly walk back through everything we just covered. We started with a plain metal building generating $50 billion a year nationwide. We saw what it costs to build or buy one and how financing and due diligence work. We broke down the revenue: rent, insurance, fees, retail, and auctions. We uncovered why operating costs stay so remarkably low. We explored the tax advantages that make wealthy investors love this asset class. We met the big REITs, the mega deals, and the quiet millionaires who built empires slowly. And we weighed the real risks against the real rewards. So after all of that, one plain metal building starts to look a lot more interesting. Let us know in the comments. If you're curious about the real economics hiding behind everyday businesses, you are in the right place. Every week, we open the door on another business most people never think twice about. Subscribe and turn on notifications so you don't miss the next one. Thanks for watching, and we'll see you in the next episode. Subscribe, hit that bell, and we'll see you soon. Thanks again for spending these 20 minutes with us. See you in the next one.